Hi, my name is Nicole, and this video is about call option assignment risk. Imagine this scenario. You're trading a covered call, a call credit spread, a synthetic short, or any strategy with a short call component. Everything's going according to plan, then suddenly you wake up to find you are short actual shares instead of holding your planned position. Today I'm explaining call assignment risk, a possible outcome that confuses many traders and can completely transform your trade overnight. But more importantly, I'll show you how to identify when it's likely to happen and how to manage this risk before it catches you off guard. So before we begin, I want to go over an important caveat. Most U.S. equity options are American style, meaning they can be exercised anytime before expiration, unlike European style options, which can only be exercised at expiration. Examples of European style options include SPX index options and VIX options. This video pertains to American style options. So let's go over a quick refresher. When you sell a call option, you're collecting premium in exchange for giving someone else the right to buy shares from you at a specific price, the strike price. This obligation lasts until the option expires. The call buyer can exercise this right anytime before expiration, not just at expiration. If the owner of the call option chooses to exercise their right, you are obligated to sell them 100 shares at the strike price, even if you don't own those shares. Assignment risk occurs when the buyer of your short call option decides to exercise that right to buy shares from you. When short calls get assigned, it can completely change your position structure and margin requirements depending on what strategy you are running. The good news is that early assignment is relatively rare unless certain criteria are met, and that's why it's crucial to understand what those criteria are so that we can manage the assignment risk. Assignment doesn't happen randomly. There are specific situations where call holders are likely to exercise early. The first is ex-dividend dates. If a stock is paying a dividend and your call is in the money, the call holder might exercise the day before ex-dividend to capture that dividend payment. Here's why. Assignment typically happens when the extrinsic value of the call option is less than the dividend being paid. Let's go through a quick example. If a call option has only 50 cents of extrinsic value left, but the stock is paying a $2 dividend, it makes economic sense for the call holder to exercise early. They give up the 50 cents in time value, but gain $2 in dividend income for a net benefit of $1.50. So let's hop into the thinkorswim trading platform here to demonstrate what we just discussed. And as you can see, I have SPY pulled up in the trade tab. And we're going to notice that in the information displayed in the trade tab, the previous dividend paid by SPY was $1.76. The dividend frequency is quarterly, and the previous ex-dividend date was June 20th, 2025. So in the real world, we don't really have to worry about it because the product went ex-dividend on June 20th. It is now mid-July, and it's paid quarterly, so that's a ways off. However, for the purposes of this example, we're going to assume that the ex-dividend date is coming up tomorrow. And I do have an established position in SPY. I'm short the 590 straddle in the August 15, 2025 expiration cycle. And as a result, I have 10 short calls at the 590 strike. And I'm going to take a look at the extrinsic value remaining in those short calls to see how that compares to the dividend being paid. And we're just going to assume that the dividend coming up is very similar to the previous dividend, which is $1.76. So in this scenario, the extrinsic value is greater than the dividend being paid. And let's just calculate what the difference is there. So the difference is roughly $2.04. And that means that if someone were to choose to exercise those calls that I'm short, they would be giving up $2.04 in value for doing so. So there wouldn't really be any motivation for them to do that. So I'm going to assume that I'm fairly safe under a scenario where SPY would be going ex-dividend tomorrow. Now let's see how expiration might affect this. So we're going to take a look at the same position, but in a much closer expiration. And so the straddle price was the 590 strike. And the calls, of course, are the ones that are in the money and they're at risk for assignment. And let's just take a look at what the extrinsic value would be if I held short calls there. And the extrinsic value is $1.06, which is less than the dividend of $1.76. So remember, that is, remember, that is what puts us at risk of assignment. And what's the difference there? It's a 70-cent difference. Okay, so that means that someone would be motivated to exercise those call options because they would make 70 cents on that transaction. So the bottom line is call option assignment risk is high when the extrinsic value of the option is less than the dividend being paid prior to the ex-dividend date. Be sure to close the short call position if you want to avoid assignment in this scenario. The likelihood of assignment is also a little bit higher for deep in the money calls. When calls are deep in the money with little time value left, holders might exercise early since there's no benefit to waiting. Deep in the money options can sometimes have wide bid-ask spreads due to lack of liquidity, making it more attractive to exercise the option rather than trying to sell it in the market. And I'll say that I have only exercised an option twice in the last 25 years, and the reason why I did that was because of this issue. Lack of liquidity and wide bid-ask spreads actually made more sense for me to just exercise the option as opposed to selling it. Now let's talk about the real impact this has on your trade. When assignment happens, several things change immediately. First, position change. Your original strategy structure gets disrupted. Whether it was a covered call, credit spread, or synthetic position, you now have a short stock component that wasn't part of your original plan. Next, margin requirements. Short stock positions typically require more margin than most option strategies. You might get a margin call overnight, especially if you weren't prepared for this position change. If this happens, you'll need to either deposit more cash into your account, close the short stock position, or sell other holdings to meet the margin requirements. Next is dividend obligations. If assignment happens before ex-dividend, you're now obligated to pay the dividend to whoever you borrowed the shares from, a cost that wasn't part of your strategy. Also, Greeks change. Your position's Greeks shift because you now hold actual stock instead of just options, affecting how your position responds to price movements, time decay, and volatility. And your risk profile changes as well. Your strategy's risk profile fundamentally changes. So not only do you have changes in exposure to delta, gamma, theta, and vega, but now you have borrowing costs and potential dividend obligations that weren't factored into your original plan. So here's how to protect yourself from unwanted assignment. 1, monitor ex-dividend dates. Always know when stocks in your options positions are going ex-dividend and mark these dates on your calendar. If assignment risk is high, close your position before the ex-dividend date and reestablish it afterwards if you still want the exposure. Alternatively, you can roll the calls up and out in time so that the extrinsic value becomes greater than the dividend amount. Next, check your extrinsic value regardless of dividends. If your short call has little to no extrinsic or time value left and is in the money, consider closing the position before expiration. And finally, simply plan for assignment. If you are assigned, decide quickly whether to keep the short stock position or close it out. When you plan ahead of time, you won't let emotions drive your decision. So here are my final thoughts and key takeaways. Assignment risk can happen anytime with American-style options, but it is rare unless certain criteria are met. This is specifically when extrinsic value is low relative to dividends or when calls are deep in the money with little time value left. Ex-dividend dates are the highest risk period, and the deeper in the money your short calls are, the higher the assignment risk. Always have a plan before assignment happens. Don't make emotional decisions after the fact. And assignment risk is part of trading options with short calls. Understanding when it's likely and planning for it keeps you in control instead of being surprised. Assignment risk might seem confusing at first, but it's manageable when you understand the criteria that make it likely and plan for it accordingly. If you found this helpful and want to learn more about advanced options trading concepts, make sure to subscribe for more educational content. And if you have questions about assignment risk or specific scenarios you've encountered, drop them in the comments below. As always, be awesome, and thanks for listening.